Good day, everyone. For today's topic, we'll discuss about business finance. When we say export financing, this is a cash flow solutions for the exporters. Export finance facilitates the commerce of goods internationally. The sellers agrees on the payment terms of the cross-border buyer. Thus, there is a cash flow issue. The supplier ships the goods overseas while the payment will be received at a later stage. Export finance allows the businesses that sell products to another country to get access to working capital before their clients pay for the products purchased. So, the business finance has legal entities. The person or people running a business may organize it in of the three basic ways, which are a sole trader, a partnership, or an incorporated company. So, when we say sole trader, ito yung from the word sole, ibig sabihin na one person ang nag-o-own ng business na ito. Ang entrepreneur na ito ang siyang lahat ng gumagawa o nangangasiwa ng kanyang sariling business without the help of other person. Ito din yung simplest business form under which one can operate a business. So, punta naman tayo sa advantages ng sole trader. So, first, low startup capital sapagkat dito walang capital na nire-required o walang minimum level of capital, hindi kagaya ng ibang business na malaki ang capital para makapag-start ng business. Another advantages, dahil isa ang nag-own ng business, for sure, na wala siyang kahati kung kakaroon ng profit na magiging niya at wala siyang kasunduan sa government na magkakaroon ng kahati sa profit niya. Then, simple to organize sapagkat pag sole proprietorship, ikaw lang ang magdidesisyon para sa isang or para sa iyong business. It is easy to organize or easy to establish. You don't need to take any legal steps to form this type of business. Being a sole proprietorship, you make all important decisions, are generally responsible for all day-to-day activities. So the disadvantages of the sole trader, all debts of the business are the owner's responsibility. The owner has unlimited liability. There may be a tax disadvantages. If the owner becomes ill, the business is at risk. So, dito, the business of the sole proprietorship is dependent on the life of the proprietor. Then it can be difficult to raise extra capital for the expansions. Unlimited personal liability, ang sole proprietorships do not have the protections of limited liability. The sole owner has unlimited liability, which means that sole owner is personally liable for the debts and expenses of the business. Next is the partnership. Partnership Act of 1890 defines a partnership as the relation which subsists between persons carrying on a business in common with a view of profit. It is a form of business where two or more people share ownership as well as the responsibility for managing the company and the income or the losses of the business generates. So, advantages of partnership: easy and cheap to set up. The partners can pool their knowledge, experience, and resources. No legal formalities are required to set up a partnership. In case of illness, there exists a better chance of continuity. Profit after tax are divided among the partners. In short, two heads are more better than one. Your business is easy to establish and start up costs are low. And partnership advantages, more capital is available for the business because kayo nga ay dalawa or partners. Then you have a greater borrowing capacity and high caliber employees can be made partners. Then the disadvantages of the partnership. The liability of the partners for the debts of the business is unlimited. Then, disadvantages of partnership: each partner is jointly and severally liable for the partnership's debts. That is, each partner is liable for their share of the partnership debts as well as being liable for all the debts because you have a partners. And the third legal entities is the incorporated companies. When you say incorporated companies, there are the process or fact of legally making a company into a corporation or part of a corporation's large company or group of companies that is controlled together as a single organization. This company has been through many changes to its structure since its incorporation. Incorporation is the legal process used to form a corporate entity or company. A corporation is the resulting legal entity that separates the firm's assets and income from its owners and investors. So, when we sum up the advantages of the incorporated companies, that corporation include personal liability protection, business security and continuity, and easier access to capital. There are many benefits of incorporating your business, and the most important ones include asset protection through limited liability, corporation identity creation, perpetual life of the company, transferability of the ownership, and ability to build credit and raise capital, flexibility with the number of business owners. Then the disadvantages of the incorporated companies, that private limited company is a type of organization you can set up to run your business. Company ownership is split into shares owned by shareholders. A company must pay corporation tax out of any profits and can then distribute the remaining profits among the shareholders. So, the incorporated companies have three basic types, which are the private limited company, the public limited company, and quoted public limited company. When we say public limited company, there are designates a company that has offered shares of stock to general public. When you say private limited company, this is a type of organization you can set up to run your business. Company ownership is split into shares owned by shareholders. A company must pay corporation tax out of any profits and can then distribute the remaining profits among the shareholders. When we say quoted public limited company, means a company who has its equity share capital officially listed on a particular stock exchange.
Equity or share capital, a combination of share capital, long-term loan capital, and short-term facilities. An overdraft from a bank is the most common arrangement. Ideally, a significant proportion of the company's finance will be provided by ordinary shareholders, as this is permanent capital invested in the company which will not normally be paid back. Next is ordinary share. Ordinary share holders have a share in any profits that have been made that year after tax has been deducted and interest on any loans paid. If the directors agree, the shareholders are paid a share in the profit in the form of a dividend. A dividend is simply the sum of money payable to a shareholder. Preference shares. These shares have a fixed rate of dividend expressed as a percentage of nominal value, which is paid before the dividends of an ordinary shareholder. Preference shareholders do not have a right to a vote. Cumulative preference shares, a company may not earn enough 1 year to be able to pay a fixed rate of dividend on its preference shares. With a cumulative preference share, any shortfall is carried forward to the next year. Debenture or secured loan stock. Debentures are the written acknowledgments of debt and are documents given to people or institutions who lend money to companies. Unsecured loan stock. Unsecured loan stock is also a tradable debt instrument that is similar to preference shares, although it ranks above preferences shares in a liquidations. Debenture or secured loan stock. Debentures are the written acknowledgments of debt and are documents given to people or institutions who lend money to companies. The document will inform the lender when they can expect to be repaid, how much is interest they can expect to receive, Debentures holders do not own the company, have a vote, have a say in a running the business. However, they do have a right to receive their interest every year or half yearly, a right to sell their debentures on the market. Unsecured loan stock. Unsecured loan stock is also a tradable debt instrument that is similar to preference shares, although it ranks above preferences shares in a liquidations. Working capital. Working capital is the difference between the current assets and current liabilities of the business. The funds which are left after all debts are paid and are therefore available to run the business by paying salaries, suppliers, etc. Next is stock. Stock can be made up of raw materials, work in progress, and finished goods. Excessive stock levels are an inefficient use of resources. Debtors. Those who owe the company and willingness to wait to be paid in a given LRC. Overdrafts. It is attractive and profitable to run a business using the bank's company or money, but there are limits on the facility the bank will allow, and they can also always withdraw or reduce such a facility. The bank security is a legal floating charge over all the assets of the business. Financial reporting. Accountants follow agreed principles when recording the transactions of a business. The balance sheet, profit and loss account, and other related relevant documents. Management information, management reports, which includes more frequent reports than the balance sheet and the profit and loss account. Okay, first is the balance sheet. So, the balance sheet shows what the company owns and what it owes at any one moment in time. Profit and loss account. Cost of manufacture. This is the total expense involved in purchase and manufacturing of goods for sale. Gross profit. This is the profit earned by the business by trading or trading account. Net profit. From the gross profit, we can deduct all the incidental expenses of running the business to calculate the net profit. A balance sheet always balance because everything the company owns must have been paid for by money acquired from elsewhere, from shareholders or bank, or the sale of current assets such as stock, etc. Figure 8, 1.1, vertical balance sheet layout. Sources of finance, fixed assets plus working capital, or yung current asset minus current liabilities. Next is the business cost. Cost can be divided into two categories: costs which are either direct or indirect, costs which are either variable or fixed. Budgets. A budget is a tool for management control. The quality of any budget is only demonstrated when management can use it to control the business in such a way that it successfully achieves its objectives. Strategy. The preparation of a budget will enable managers to see if the company's strategy makes sense. Next is the 5 rules of budgeting. 1. A budget is not a license to spend money but part of the process of delegating responsibility. 2. When preparing a budget or any other type of business plan, always start with the sales forecast. 3. Implementing the budget involves motivation, so everyone is working to the same objectives. Communication, so people can talk to each other about it. Monitoring, or how are we doing so far. 4. The actual figures will always be different from the budgeted ones. It is the size of the variance which matters. 5. Budgeting is a continuous rolling process, so it is always monitor, revise, monitor, and so on. Absorption costing and marginal costing. Absorption costing, an absorption cost is the total cost divided by the number of units produced. If we want to know the cost of a product or batch, there is no problem with the direct cost. We simply take all those costs directly attributable to that product or batch and add them up. It is the indirect costs which are the problem. If this can be apportioned in some way to each cost unit, then the total cost attributed to all the cost units together will equal to the actual total cost of the business. This process of spreading the indirect or overhead costs over the range of cost units is what absorption costing does. A marginal cost is the cost of producing one extra unit and will therefore be made up of variable cost. It is not about absorbing overheads. It only considers the variable costs associated with a product. A marginally costed product can be sold at a marginal price, which will be lower than a full absorption price. A product which looks to recover only its variable or direct costs will make no contribution to the fixed or indirect cost of the business. International payment methods. This primarily relates to the choices made regarding the terms and methods of payment used for particular countries and customers. Terms of payment are the time allowed for payment to be made, the LRC period allowed. This is usually expressed as site payment, which no period is allowed, or in blocks of 30 days, 60, 90, and 180 days, following a date specified in the contract, which could be from site of documents or from date of shipment or from the invoice date. Method of payment is the means by which the money will be paid in the end. The exporter has a range of choices which offer varying degrees of security. Next is the market. Certain methods of payment are clearly more common in particular markets than are others, so the exporter invariably, as a rule of thumb, as to the usual method of a particular market. In this context, it is no surprise that for high-risk markets, for example, West America, then cash in advance is not uncommon and letter of credit are very common. On the other hand, a developed market like Germany exhibits a preponderance of open account contracts. Companies like Standard & Poor's and Moody's can provide long-term ratings of countries, and also large corporations like banks. For the typical exporter, shorter-term ratings are obtainable from Dun and Bradstreet and other specialized agencies.
So, in this figure shows the payment methods rank according to security. It is least secure to most secure. First is the open account, then bills of exchange, documentary letters of credit, and cash in advance. Next is the competition. It could be the case that the competition faced by a particular exporter is prepared to use terms and methods of payment as a marketing tool. That is, they are prepared to agree longer letter of credit periods or less secure and often cheaper methods of payment in order to secure business. So, in any decision regarding the terms and method used must be based on the application of all the above factors and underpinned by a very clear understanding of the operation of the various methods, the risks involved, and the ways in which good management can minimize those risks. Then, cash in advance with order. First, the most secure method of payment for the exporter. If you can get it, it is because of exporters' perceptions of an increased credit risk in world trade and the fact that they do not regard letter of agreement as an absolute guarantee that there has been a clear increase in the incidence of advance payments. It is increasingly the case that overseas buyers in certain high-risk countries also accept it as the normal method of payment subject, of course, to their exchange controls. Next, open account. The least secure method of payment and therefore only used regularly in low-risk markets. The seller will send the goods and all the documents direct to the buyer and trust them to pay on the agreed date. It is important that it is made absolutely clear when payment is due and where the payment is going. So, in when payment is due, this may be on receipt of documents or goods which would invariably be sent direct to the buyer or after a letter of credit period of typically 30, 60, or 90 days after a specified date of invoice. Then, where the payment is going, an export invoice should specify full company name, full business address, name of bank, name of account holder, bank branch address, account number, sort code, and SWIFT code. Next is how the payments will be made. So, it will be made by cash, buyer's cheque, banker's draft, and international transfer. Then, documentary collections. The use of bills of exchange, sometimes called drafts, introduces a new documentary requirement for the exporter in that the bill of exchange will be drawn up by them in addition to the other shaping documents. So the security which bills of exchange offer is based on the fact that the procedures involve the banks in arranging for collection of payment from the buyer on behalf of the seller. In that figure shows the processing the bill of exchange in export trade. The exporter, having agreed such a method of payment with the buyer, will draw up a bill of exchange which will form a part of the document set which will be sent to their bank in the UK, who will send the documents to a bank in the buyer's country, often the buyer's bank, who will negotiate payment. Next is avalized bills of exchange. As we have seen, a term bill accepted by the drawee is not a guarantee of payment on maturity, but it is possible to arrange for the accepted bill to be avalized by the buyer's bank. This must be arranged in advance and involves the bank adding their pour aval endorsement or guarantee to the accepted bill. So yun nga, accepting a term bill is not a guarantee of payment on maturity, but it can be arranged for the accepted bill to be avalized by the buyer's bank. This must be arranged in advance and involves the bank adding their pour aval endorsement or guarantee. Then, documentary letter of credit. Most exporters will feel that a promise from a bank to pay is an improvement on a promise from the buyer, and we have seen above that the addition of a bank's pour aval on an accepted bill of exchange gives distinct advantage. A bank's pour aval on an accepted bill of exchange gives distinct advantages to exporters. Most exporters will feel that a promise from a bank to pay is an improvement on a buyer who has not been able to show that they can afford to make the payment. In that figure shows the processing a letter of credit, drafts bill of exchange which are often drawn on the issuing or the confirming bank. That is to say that the drawee on such bills will be a bank rather than the buyer. The bills reflect whether the letter of credit is payable at sight or contains a letter of credit term, as can be seen from figure 8.2.9, which requires a 90-day bill. Types of letter of credit. Irrevocable. An irrevocable letter of credit cannot be cancelled or amended without the consent of all parties. So it is irrelevant if the buyers change their mind or even go out of business. The only thing that can invalidate the letter of credit is if the issuing bank go out of business or a government moratorium means that trading must cease with a particular country. Next is revocable. It is possible but unusual to trade with revocable letter of credit, which, as the name suggests, can be cancelled or amended by either party. So they are only used where the parties are closely related as a means of efficient funds transfer, not as a security of payment. Then confirm. As mentioned above, it may be in the exporter's interest to obtain the promise of a bank in their own country to pay by adding their confirmation to the letter of credit in addition to the issuing bank promise. So whether this is insisted upon or not should depend on an informed assessment of the reliability of the issuing bank and not simply as a blanket request. Next is transferable. In the cases where a middleman operates between a manufacturer and an end user, it is possible for a letter of credit to be raised showing the agent as the beneficiary but also allowing the transfer of a percentage of the letter of credit to the manufacturer. The difference is the agent's profit, and the manufacturer must meet the conditions of the letter of credit to obtain their payment just as the agent must. Then, revolving. Where a series of identical shipments are to be made, it is possible to raise one letter of credit to cover all of them rather than a separate letter of credit for each shipment. So, they are known as revolving because after payment against a shipment, the amount payable is reinstated for the next shipment. Next is deferred payment. They are becoming increasingly popular where a letter of credit term has been agreed but the parties wish to avoid raising a bill of exchange under the letter of credit. It means this will usually be because the bills attract stamp duty in the issuing country. Next is barter, the direct exchange of goods for goods. Overseas markets with excess commodities trade them for negotiated quantities of imported goods with no cash changing hands. So there are specialist consultants who will handle the disposal of the bartered products on behalf of the exporter. Counter purchase. As a condition of securing the export order, the seller undertakes to purchase goods or service from the country The counter purchase contract can be anything from 10% to 100% or even more of the value of the export sale. Then, buyback, a form of barter in which the suppliers of capital equipment such as manufacturing plant agree to accept payment in the form of the output of the manufacturing unit. This has the distinct added advantage that the small to medium-sized European manufacturers supply equipment. Then offset, a condition of the export would be that materials and components which originate in the importing country are incorporated in the finished product which they eventually receive. Means it is particularly relevant to high technology products such as aircraft and defense systems, and may even involve the exporter participating in the establishment of production units in the overseas market. Yan. Forms of counter trade. First, counter trade is an inherently ad hoc activity. The mechanics vary according to local regulations and requirements, the nature of a goods to be exported, and the current priorities of the parties involved. The terms used to describe the main modes of trading vary, often interchangeable, fueling confusion. The most common forms of counter trade and the terms usually applied are counter purchase, barter, buyback, offset, switch trading, and evidence account. So, counter purchase. The value of the counter purchase undertaking may vary in value between 10% and 100% or even more of the original export order. The agreement can vary from a general declaration of intent to a binding contract specifying the goods and services to be supplied, the markets in which they may be sold, the penalties for non-performance, and perhaps other matters. Switch trading. Imbalances in long-term bilateral trading agreements sometimes lead to the accumulation of uncleared credit surplus in one or other country. So, transactions are known as switch or swap deals because they typically involve switching the documentation and destinations of goods on the high seas. Switch deals can be very complex, involving a chain of buyers, sellers, and brokers in different markets. Last, evidence accounts. Companies or traders with a significant level of continuing business in certain markets may be required to arrange counter purchase exports from those markets at least equivalent to their own imports with the country concerned. So exports must be balanced against imports to ensure they are of equivalent value to their counter purchase counterparties' imports. A firm may maintain an evidence account debiting its own imports and crediting the exports it has arranged over a period. The account must be maintained in balance year by year. So, that's all po. Thank you po.